Today we're going to take a look at planning for retirement. In particular, we're going to take a look at how we're going to spend all of that money that we spent an entire life collecting. We started off in this program by looking at ways to budget, ways to manage buying a house. We looked at the process in our most recent session of saving for retirement. So when we get to retirement, how much money are we going to need in order to retire? What's going to happen if we run out of money? One of the biggest concerns that most Canadians have. Well, this session builds on the previous 6 weeks of material that we've looked at, covering a broad range of topics. It's supported by Chapter 15 in the Madura and Gill textbook, and it precedes our final session where we take a look at estate planning, including things like wills and powers of attorney. Retirement is definitely a session, or definitely a topic, that is fraught with concern. Canadians are typically very concerned about their retirement. They've planned for it, they've had an entire life to think about it, but probably in the last 10 years before retirement, people become very focused, wondering how much money will I really need in order to retire? What will happen if inflation eats up all of my savings? Will I be able to maintain the lifestyle that I've had in the past? What happens if something goes wrong? Some of the most typical concerns that people have expressed concerns having to retire to essentially a life of poverty. And what if we make that irreversible decision to leave our job and go into retirement and discover we haven't got enough money? A lot of Canadians in retirement do say that they did not expect to see a lifestyle that they eventually got. A lot of Canadians are concerned that they will outlive their savings. Canadians in general may not appreciate the costs of providing for health care in retirement. And in many cases, retirement may be involuntary. In other words, having to retire because of company downsizing or health issues or family issues. It helps to have a checklist going into retirement. What are the things that I should be thinking about planning for retirement? What kind of a budget will I need? That would be one of the first steps. And of course, having had the experience of budgeting throughout your entire life, probably there's some small adaptations that are required, and in many cases not such major adaptations. As we'll see later, people will discover that they will require between 70 and 90% of their pre-retirement income, and understanding the differences in spending are certainly a good place to start. We have an opportunity to elect to receive pension benefits from the government at different points in our life, and deciding at what age we're going to receive those will determine how much we're going to receive. Also, understanding your tax situation will be part of that. Taking a look at things like insurance coverage to see if we have the right amount of insurance, or perhaps too much insurance for our current levels of liabilities and the needs of our beneficiaries. What will happen to your pension if you continue to work? Will you have to give up part of that pension? Will taxes remove a lot of that pension benefit? What about things like pension splitting or pension sharing? We'll look at that in a couple of minutes. How to protect yourself from financial fraud, maintaining financial independence, looking after the beneficiaries by planning for your estate, thinking about what you'll do in retirement. Will you continue to live in the same house that you've lived in before retirement? Will you consider downsizing? And how about things like traveling and hobbies? Will the cost of living significantly impair your ability to do some of the things that perhaps you've planned to do? There are a number of simple rules of thumb. For example, in The Motley Fool, they tell us that if we're planning on retiring and taking 80% or perhaps 90% of our income, if we perhaps will have other income in retirement, passive income or perhaps a part-time job, that would be able to subsidize or pay for part of that. If we take that monthly value, multiply it by 12, that tells us the total value of our annual living costs. So if we discover, say, 80,000 is going to be our expected cost of living in retirement, multiply that by 25, that'll give us the size of the savings that we should have going into retirement. There's a simpler way to do that, perhaps, if you just decide that, say, I need $80,000 a year to live in retirement. If you divide that by 4% as a kind of rule of thumb number, that'll give you an idea of the total amount of wealth. So, say, 80,000 divided by 0.04 says you'll need $2 million in savings. A couple of tricks or a couple of rules of thumb, but clearly those are just a rule of thumb. They don't give us a true picture of what we're going to need, and for that there are a number of retirement planners that are available that will help. A good example of that is available on the Government of Canada website, where through a very long and complicated series of menus, we eventually build a profile of the requirements of our own personal savings and help us to create a budget for ourselves going into retirement. There may be several changes in your retirement expenses as you move into retirement. A lot of things are going to remain the same or rise with inflation. Some things proportionately with inflation. We've already seen things like the cost of food and gas can be much greater in an inflationary period. And if you're on a fixed income, that's really a problem. Other costs like insurance, utilities may rise just directly with inflation. Other costs perhaps not rise so much. The cost of insurance may increase, but you may also elect to have less coverage because your beneficiaries are not going to really be as dependent on you as they were when you were in your 30s. You don't have to pay for travel for work, so you don't have to budget so much for car expenses perhaps or for parking. Although you may decide that you want to travel for fun. And traveling for fun, doing some international travel, spending money on your hobbies might be something that you'll increasingly want to include in your budget. How about a mortgage? Are you going to still be carrying a mortgage in retirement? It was one of those things that we just took as self-evident in the past that when you retire, your mortgage will be paid off and you'll no longer have to worry about that cost, which in the early stages of your life might have been closer to 40, even 50% of your total income. So will you carry a mortgage into retirement? And we'll see in a minute, increasingly people are doing that kind of thing. The idea of a mortgage that will last your entire life is no longer so strange, especially in very expensive housing markets like the Lower Mainland and British Columbia. This session we're going to focus in particular on converting your wealth into income. And how do we do that? And of course, your wealth comes from a variety of sources. Pension plans, like the defined benefit and defined contribution pension plans. Perhaps you have a profit sharing program that allows you to capitalize on that going into retirement. Savings that you've created for yourself through an RRSP or a locked-in retirement account, a LIRA, that may also be a source of wealth that you can convert. And of course, any other investments that you've got that you may convert from perhaps an investment in real estate or an investment in a portfolio of stocks, that will also be part of your consideration. Let's start off with for the defined benefit plans. When you talk to the HR department at work and say, hi there, I'm thinking about retiring this year, they will go through a step-by-step process of planning for that retirement. And you'll be able to elect, most likely, if you have a defined benefit program, becoming more rare each day, you'll be able to elect the type of payment that you're going to receive and to a certain degree the amount. Some of the things that they'll ask you, will your pension be a pension for you as an individual or for you and a spouse? If that's the case and something happens to you, your spouse will receive at least a part of the pension. You can also make a decision whether or not you're going to receive a guaranteed number of years of payout, even if something happens to you or both you and your spouse. So the idea of a guaranteed pension period is also something that you can negotiate, but all of these things come at a cost. As you'll see from this table, the largest single payout that you could receive in this particular case is for a single lifetime pension. That means if something happens to you, the pension will stop. If you die after 3 years, then you'll receive the money for the 3 years, and then after your death, nothing is payable. That's one of the reasons why the payout is the largest in that case at $56.31. Now, you could elect to have a beneficiary identified, a survivor, so that if something happens to you, the payout will continue. And here we've got a couple of options. One, guaranteed for at least 5 years. So your beneficiary would receive, or you would receive, for at least 5 years, the sum of $4,910. You could go for a joint lifetime policy with 1/3 of the amount guaranteed for at least 5 years. So a middle ground amount. You'd receive a larger amount of money, guaranteed for at least 5 years. Your survivor would only receive $35.39 if something happened to you during that 5-year period. Here we can see there are a number of other options that basically say we want a guarantee, and with reducing amounts so that you could have the largest, if you knew something was going to happen to you, you could get a guarantee of up to 15 years of income and receive a reduced amount of $54.35. And of course, with nothing for a survivor in that case. Those are some of the payouts that can be determined at the time of your retirement. Defined contribution is also going to be a similar type of process, but because we don't have to negotiate with our employer, it's going to be much more up to you. At the time of retirement, you can turn your defined contribution pension plan at work into a locked-in retirement account. Essentially, this looks like a LIRA looks an awful lot like an RRSP, but there are a few additional conditions. When you retire, your LIRA can then be converted up to age 71 into a life income fund. Now, we'll talk about RIFs. We have talked about RIFs already, registered retirement investment funds that are essentially set up to work with RRSPs. Well, an LIF is a type of annuity which is set up to work a lot like a RIF. If you have RRSPs, can be completely withdrawn, essentially cashed in with significant tax implications at the time you retire. In fact, anytime after 60 you can start to convert an RRSP. In some conditions, particularly disability, even earlier. But when you collect money from your RRSP, when the money is taken out of the RRSP and converted to cash, it becomes a taxable liability. And that can be a real problem because in retirement you may not have as many deductions as you had when you were younger, and there's a real possibility that your marginal tax rate in retirement could be higher than it was while you were working. So your tax liability would be significant. Take $10,000 out of your RRSP, perhaps you could end up spending $3,500 or $4,000 in tax. People may elect to take the smaller amount out, especially while their income is higher, if they have income from other sources. But you still have to take out something every year. And you can see from this table that there is an increasing scale of the required withdrawals from your RIF. If you're 65, for example, at the current rates, you need to take out about 4% of the RIF per year. By the time you get to 95, that number rises to 20% of the RIF. The idea being that you should be able to draw down your entire retirement savings plan by the time you pass away. A couple of other things, if you already have a LIRA, which may be the case if you've quit a job that had a defined contribution plan, they will probably have rolled over that defined contribution plan into a LIRA, a locked-in retirement account. As I say, it can be self-directed, look an awful lot like your RRSP, but there are more conditions about things like withdrawals. A LIRA is normally turned into a life income fund, the equivalent of a RIF It works exactly like a RIF, except that there's a maximum annual withdrawal. You can see that the LIRA is largely provincially administered, and so if you're operating in different provinces like Newfoundland, Manitoba, Saskatchewan, there may be different versions of the LIF that you work with. We talked a little bit earlier about things like income splitting. If you have a spouse who earns significantly more or less than you, it may be advantageous to split income during your working life, and you can do the same thing in retirement with your pensions. Income splitting is a bit different from income sharing, and I'll try to help you with that distinction here. Income splitting basically says that after age 65, anyone can split income with their partner from things like a defined benefit pension plan, an RSP annuity, or RIF, but not for things like Old Age Security and Canada Pension Plan. This means that we're going to deal with income splitting when we file our taxes. You can still manage to split income, we say share income, when we're using the Canada Pension Plan. But rather than doing that at the level of taxes, we do that by election when we're arranging the payout of our Canada Pension Plan. So you can say that I want to share my Canada Pension Plan income with my partner. The same net effect, it's just the mechanism is different. Another interesting way that we can harvest our wealth, if we've got a lot of money invested in our principal residence, in our property. Of course, you've heard the expression house poor. Basically, it started off saying that you were house rich and income poor because you had a lot of money invested in a house, but you didn't have much cash. Well, one of the ways around that for seniors, rather than to move out of their house, is to use a reverse mortgage. In retirement without income, something like a home equity loan doesn't make a lot of sense because you haven't got the income to repay a home equity loan. So the remaining option is largely a reverse mortgage. You may have heard of the CHIP program, essentially one particular commercial program that allows people to reverse mortgage their house. If you're over 60, you can borrow up to 40% of the value of your property. For $1 million property, you could borrow up to $400,000. There's a limit. The total amount that you can borrow would be a maximum of $500,000. Now, since you haven't got the income to pay the interest accumulates. And so when you die or when you liquidate your property, the mortgage becomes payable, both interest accumulated as well as the principal amount that you borrowed. There's typically a cost of about $1,500 to $2,500 to set up a reverse mortgage, and of course it results in the estate being worth a lot less when you eventually pass. Something that's not mentioned in the textbook, but a lot of people in British Columbia take advantage of, is deferred property tax. Property taxes are becoming larger every year, a greater burden every year as properties increase and government spending does as well. So an annual bill that arrives in July for $2,500, $5,500, $10,000 even is very difficult if you're on a fixed income. Of course, that can be spread over the year, but for many seniors, that's just a cost that's too much. And so as a result, people have elected to defer their property taxes until the time that they sell the property, and at which point the taxes have to be repaid, or at the point that you pass and the house is sold and the taxes again are going to be repaid. So deferring property tax is available in certain circumstances to younger families can defer property tax in one program. The other program involves people who are over the age of 55. A surviving spouse or a person with disabilities can take part of this. And check the website with the province of British Columbia if you feel that that's something that would be interesting. Now, an interesting term that we are still coming to terms with ourselves is the idea of retirement age. It used to be fairly simple. In Canada, the mandatory retirement age was 65 until 2009. At that point, we pretty much did away with the idea of mandatory retirement. So if you turn 65 in 2008, your employer would say, "Congratulations, you've reached the finish line. Now sign your retirement papers and out the door you go. Your health benefits are gone. The option to work might have been there, but your existing contract would have expired." So university professor might have hit 65 and off they go and perhaps come back to teach the occasional summer course. Well, after 2009, we're no longer able to do that. Employees continue to work until there's some kind of an obvious disability or can continue work until there's an obvious disability that impairs their ability to continue. We see right now that the average retirement age in Canada is 63 and a half. And in many cases, the benefits that we receive from retirement are going to require us to work even later. In the next few years, that's going to rise. The normal retirement would rise to from 65 to 67 in order to receive full benefits from many programs. You can retire earlier than 65. Benefits are typically reduced significantly if you retire before 65. For example, with the Canada Pension Plan, benefits at age 60 are about 36% less than they would be if you worked to 65, and if you continue to work till age 70, they would be about 42% greater. One calculation that used to be typically used for a lot of employment programs, employment contracts, would be called the 85 factor. And essentially it said you could receive full pension by taking the age at retirement plus your years of service, and that would have to equal 85. So if you had worked for 25 years for a company, and then you added that to age 60, your current age, that would give you the full 85 points, which would enable you to retire. So while that's still useful in terms of thinking of what normal retirement age would look like for a defined benefit program, it's no longer statutory. Pensions and budgeting in pension in your retirement is something that you probably want to spend a little bit of time thinking about. In fact, it is part of our assignment. So what kind of expenditures do you expect to see in retirement? Here's an article from Maclean's magazine. Back, if you're familiar with magazines, they're those pieces of paper that old folks tend to read. And in Maclean's, they talk about 3 different families. We've got Pam and Rob, Phil and Sarah, Ross and Helen. And we have different expense profiles for each of these 3 couples. So the cost of shelter, the cost of operating a vehicle, groceries, health and dental, home and garden, and so on, give us some of the basics on which they spend. It also describes some of the other things that they would spend money on, the extras, like recreation, restaurants, holiday home, travel, pets, and so on. And this gives us kind of a checklist of what expenses in retirement might look like for an average Canadian family. You can see profiles like this have been set up. There's a very similar example from the Globe and Mail that gives you an idea of what a budget might look like. And if you are doing this part of your assignment, you might consider using that as a kind of a template. Now, there are certain risks that are important in planning for retirement. The one risk that I think more Canadians are concerned with, they say about 47% of Canadians, outliving your wealth. If you have planned a retirement that goes to 85 and you live to 105, how do you fund that extra 20 years? Will you be living on Canada Pension Plan, Old Age Security, and the Guaranteed Income Supplement? Or will you still have enough money to maintain that lifestyle? So that's the longevity risk. Purchasing power risk, of course, relates to inflation. We know how much money we're going to receive. That's part of the contracts that we've already agreed. But what you can actually buy with that money becomes an interesting problem. I have a small pension from the 12 years that I worked for a British university. And not only do I have to worry about inflation in that case, but I have to worry about the value of the currency. So in a couple of years' time, when I'm eligible to start collecting that pension, I will receive the amount of money that was exactly the amount of money in pounds that was promised. Although by the time I do retire, the time I have to spend that money, I'm not sure if I'll be able to afford a cup of coffee at Starbucks with that benefit that's been promised. The sequence of returns is about the timing of returns from investment. One of the things that we have to be concerned with, things like movements in the market. If we put money into equities and equities are volatile, the last thing we want to have to do is sell off our equities to draw down our investment portfolio at a time the market is in a dip. So that could definitely be a problem, especially if our investments are highly volatile. Cognitive impairment. Well, there's a chance that we may no longer be able to manage our affairs because we haven't been able to keep up, or because of a medical condition like dementia. This example from the internet essentially says Americans are very similar, that 42% are concerned about outliving their investments. They have probably more concern about their health system because of the private health that they receive. Concern that the government programs are not going to exist in the future, that they're going to be let down by the government. Possible long-term healthcare costs, cognitive decline. Interesting, they don't mention purchasing power. This survey was done a year ago, before inflation started, and I'll bet inflation is a major factor right now if we were going to repeat this survey. Some of the strategies that we can adopt to manage these risks, the ways that we'll actually pay out, involve deciding to only pay out the income from investment, an income-only strategy. Of course, that has the advantage of giving us a return that protects our capital, so the pool of capital will remain the same. But it means we could end up with quite a volatile level of return and not be able to pay our bills. A fixed dollar strategy gives us fixed level of income, but it does leave us very exposed to at least three of these risks: loss of purchasing power, longevity risk, sequence of return risk. So while it would be more stable, it would also be the most risky. Taking a constant percentage. I mentioned a strategy that takes 4% of the value of the portfolio, essentially says that we'll have a portfolio that will last up to 30 years. But it also comes with that volatility that we also saw with the income-only strategy. Only taking the minimum amount from your RIF, again, guarantees your capital, means that you'll end up with the largest possible capital pool and probably the lower tax obligation. However, it means that we might have a lower standard of living than we'd expect otherwise. There are also a number of things that we describe as an income bucketing strategy, and one particular version, and I'll go through those in a little bit more detail. In an income bucketing strategy, essentially we break down our total portfolio into parts, probably at least 3 parts or 3 buckets, 3 categories. One category is there for liquidity. It provides us with an income for the next year, perhaps as long as the next 2 years. So we'll take some of our cash and we'll invest it in very short-term financial instruments like treasury bills, treasury bonds, bankers' acceptances, GICs, and even cash. And all of these things have in common that they provide us with a very low rate of return, but the value will be certain. A $100,000 GIC will be worth $100,000 plus the accrued interest. It's not going to fluctuate, it's not going to be volatile when the markets go up and down, so it provides us with more stability of returns, but low rate of return. The medium term, which may be anywhere from 1 year to 5 years, let's say, is going to be a long enough term to bracket a business cycle. So if we see the economy goes into a recession, we expect within 5 years that we'll be out of that recession. So this particular type of fund is going to be fixed income, so it's not susceptible to movements. We don't have to worry about the sequence of return problem that we mentioned earlier, but it's going to give us only a moderate rate of return. And in this particular example, they say 25% of the total portfolio would go into things like corporate bonds, municipal bonds, preferred shares. Less volatile, relatively stable rate of return. And the funds from this bucket would be used to fill the cash bucket that's essentially going to roll over into money market securities. The third bucket is where our assets continue to grow, and we put that into things like equities, which rise at a much faster rate than the value of fixed income securities. And so in this case, about 75% of the portfolio is in the long-term bucket, longer than 5 years, 5 to 20 years perhaps, expected maturities or duration on those type of investments. In fact, you can see the example from our textbook described as the Evensky and Katz cash flow reserve strategy, essentially a particular definition of the bucket strategy that was produced by a couple of financial analysts. It essentially said if you started off with $1 million portfolio, the first bucket would involve about $50,000 in money market funds and short-term bonds. Stable value, regular cash flows, however, not much capital growth. And this would be the cash flow reserve. So that's the first bucket, 1 year or less. Then we've got bonds in the second bucket, and in this case we've got 3 different durations or maturities of bonds. Short duration bonds, 1 to 3 years, medium, 3 to 5 years, and 5 years and longer. And in this case they've got a total of $240,000 invested in this particular bucket, and all in bonds and spread out among those 3 categories. So you get a relatively high rate of return. Longer duration bonds have a higher yield, but we also have got liquidity, reasonable amount of liquidity that we can use to fill that first bucket as we need to. We can sell some of those bonds and cash them in, use that money to fill the first bucket. The growth segment of the portfolio in this case, of our $1 million, $660,000 is long-term investment in equity markets. So there we go. We've had a short introduction to how to spend your wealth. This has been a summary of retirement planning. It reminds us that the important budgeting skills that we learned while we were undergraduate students at university are skills that can be used throughout an entire lifetime, but they become essentially critical at the time of retirement because there's not an awful lot of money to work with. We're working with a fixed income. That income comes from a number of sources, including things like government programs, but also converting your own wealth, your RRSPs, your LIRAs, your investment portfolios, and even your real estate into cash income. Because we're working with a fixed income and we have limited amount of recovery ability, if something goes wrong, risk tolerance falls. Seniors are very risk sensitive, and so that means that we need a portfolio that's going to minimize that risk and make sure that people understand the risk. And in that respect, the strategy that we use matters. Hope you found this useful. And I know it's going to be a long time before you get around to this stage in your career for most of us, but something that's important to start with today. I'll talk to you again soon.